Why WeWork failed despite huge revenue. In 2010, a startup called WeWork promised to change the way the world works. It wasn't just renting office space, it was selling a vision. Vibrant communities, flexible workspaces, and the idea that your office could be a lifestyle, not just a building. Investors were captivated. Valuations soared, venture capital flowed like water, and WeWork expanded into cities around the globe at lightning speed. On paper, it seemed unstoppable. Revenue skyrocketed, and the company was hailed as the future of work. But beneath the glossy marketing and Instagram-worthy office interiors, cracks were forming. Lavish spending, aggressive expansion, and risky leases masked a fragile financial foundation. By 2019, when WeWork attempted to go public, the illusion shattered. The IPO collapsed, investors pulled back, and founder Adam Neumann was ousted in a dramatic fall from grace. How could a company generating billions in revenue implode so spectacularly? The answer lies not in lack of sales, but in structural flaws, misaligned incentives, and overambition. WeWork's story is a cautionary tale of how hype, rapid growth, and revenue without discipline can create a business that looks unstoppable until reality catches up. Let's watch. 1. Revenue is not the same as profit. At first glance, WeWork's growth seemed unstoppable. Revenue soared from hundreds of millions to billions of dollars within a few short years. But revenue alone doesn't tell the full story. WeWork's operating costs were enormous. The company invested heavily in lavish office designs, premium locations, and perks for employees, while also taking on massive salaries for executives and extravagant expenses like private jets and luxury retreats. High revenue gave the illusion of success, but losses were mounting at an alarming rate. The company's model prioritized signing tenants over financial discipline, often renting more space than it could fill. Profitability lagged far behind revenue growth, creating a fragile business structure. When the IPO prospectus revealed the true scale of losses, confidence evaporated. WeWork's story demonstrates a simple but critical lesson. Revenue alone cannot sustain a business. Without profit, even billions in income can't protect a company from collapse. 2. Aggressive expansion outpaced demand. WeWork's vision of global domination pushed the company to open hundreds of locations at a dizzying pace. While the expansion strategy impressed investors, it often outstripped actual market demand. Long-term leases were signed in major cities without sufficient research into occupancy potential. Many locations failed to attract enough tenants to cover operating costs, creating a network of unprofitable offices that drained cash flow. Expansion was funded by massive rounds of venture capital, reinforcing a grow-first, profit-later mindset. While this rapid scaling helped WeWork dominate the co-working market, it left the company overextended and operationally strained. Service quality suffered as management struggled to oversee such a sprawling operation. Revenue numbers may have looked impressive on paper, but the unsustainable expansion model highlighted that scale without strategy can be fatal. 3. Risky business model and overleveraging. WeWork's core business model involved signing long-term leases on office buildings and then subleasing short-term spaces to tenants. This approach seemed clever in theory, providing flexibility for clients while generating consistent cash flow. In reality, it was highly risky. Long-term obligations meant that if occupancy rates fell or economic conditions changed, WeWork remained responsible for paying the full lease. This overleveraging left the company exposed to market fluctuations and downturns. Any minor dip in demand could create massive losses, and with thousands of long-term leases worldwide, risk was magnified. The mismatch between short-term revenue and long-term liabilities revealed the fragility of the business. High revenue numbers masked this structural vulnerability, making the company appear stable when it was, in fact, one economic shock away from crisis. 4. Corporate culture and misaligned incentives. WeWork cultivated a corporate culture that prioritized ambition, vision, and charisma over financial discipline. Adam Neumann encouraged employees to embrace a startup mentality, focus on growth, and change the world. While this energized the workforce and impressed investors, it created misaligned incentives. Employees and executives were rewarded for signing new leases and expanding rapidly, not for ensuring sustainable profitability or operational efficiency. A culture of hype overshadowed prudent management, creating an environment where rapid growth was celebrated even as structural problems deepened. Extravagant perks, lavish events, and emphasis on image over substance made it difficult for employees to question unsustainable practices. The company became a reflection of its charismatic founder, bold, ambitious, and ultimately reckless. Misaligned incentives ensured that revenue growth was pursued at the expense of long-term stability. 5. Overvaluation and investor hype. Investors played a significant role in WeWork's rise and fall. Fueled by narratives of a tech-enabled real estate revolution, WeWork was valued at nearly $47 billion at its peak, despite recurring losses in the billions. Venture capitalists were captivated by the company's rapid growth and charismatic leadership, overlooking traditional financial metrics like profitability, cash flow, and debt exposure. The overvaluation created unrealistic expectations for continued growth, pressuring the company to scale faster and spend more aggressively. When the IPO filing revealed WeWork's actual financial situation, massive losses, questionable governance, and unsustainable leases, the hype collapsed, investor confidence evaporated, and the company's valuation plummeted. This demonstrates that high revenue cannot protect a company from the consequences of overinflated valuations and unrealistic market expectations. 6. Market misfit and competition. WeWork's co-working model was innovative, but demand for it was uneven. Startups, freelancers, and small companies embraced flexible office arrangements, but larger corporations often preferred traditional leases or remote work setups, limiting the market for premium co-working spaces. Competitors, both local operators and international chains, quickly replicated WeWork's model, eroding its first-mover advantage. The company consistently overestimated demand, leading to underutilized offices and rising vacancy rates, particularly in less profitable locations. While revenue figures appeared impressive, they masked the mismatch between supply and actual market needs. Profits in thriving locations were offset by losses elsewhere, creating a fragile financial structure. By prioritizing rapid expansion over careful market research, WeWork built a business that relied on continuous occupancy and perpetual new client acquisition to sustain its image of success. This approach transformed a promising concept into a high-risk venture, demonstrating that innovation alone cannot guarantee profitability or long-term stability. High revenue had created a dazzling illusion, masking losses and vulnerabilities that eventually became impossible to ignore. The dramatic IPO failure exposed not just financial mismanagement, but a culture that prioritized hype and image over sustainable business practices. WeWork's story isn't just about a failed company, it's about the dangers of conflating ambition with stability, and revenue with real success. It shows how investor enthusiasm, charismatic leadership, and a compelling narrative can temporarily conceal the cracks in a business model. For entrepreneurs, investors, and employees, the lesson is clear: growth without discipline and revenue without profitability is a fragile illusion. In the end, WeWork didn't fail because it lacked vision, or revenue it failed because it built a house of cards that couldn't withstand the realities of economics, risk, and human behavior. Its rise and fall will remain one of the most striking business cautionary tales of the modern era. Let us know in the comments what you think about why WeWork failed despite huge revenue. And don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.